Okay, let's talk about what insurance really is. Most people only think about insurance when something goes wrong, like a car accident or a roof leak, but a medical bill that feels unexpectedly large, even. So, in those moments, insurance is often treated like a promise that something bad will be taken care of, or a disappointment when it isn't taken care of. But outside of those moments, insurance tends to fade into the background. Premiums are paid automatically and policy documents are stored away. The details feel distant, technical, or irrelevant until they suddenly matter a great deal. Now, let's get into what this will cover. The following conversation covers insurance from the ground up without technical language or policy specific detail, and it focuses on how insurance functions in everyday terms rather than how it is marketed or advertised. Specifically, we go over the core purpose insurance is designed to serve, how insurance differs from savings or guarantees, why insurance exists as a shared system rather than an individual one, common misunderstandings about what insurance is supposed to do, also how risk, probability, and cost fit together, why insurance often feels confusing or disappointing, and how to think about insurance more clearly going forward. You see, the goal is not to tell you what to buy or how to choose a policy, but to help you understand the role insurance plays so future decisions make more sense. What insurance is at its core. At its most basic level, insurance is a way to share financial risk. It is not a product that prevents bad things from happening, and it is not a guarantee that losses will never hurt. Instead, insurance exists to spread the cost of rare but expensive events across many people. Most people will not experience a major loss in any given year. A house will not burn down. A serious accident will not occur. A catastrophic illness will not appear. But for the small percentage of people who do experience these events, the financial impact can be overwhelming. Insurance works by collecting smaller, predictable payments from many people and using that pooled money to help cover large, unpredictable losses for a few. This pooling is the defining feature of insurance. Without it, insurance cannot function. This is why insurance feels different from savings. When you save money, you are setting aside funds specifically for yourself. With insurance, the money you pay is not reserved for you. It becomes part of a shared pool that exists to pay claims when certain defined events occur. Confusion often arises because insurance is sold individually but operates collectively. Each policyholder has their own contract, but the system only works because many people participate together. The premiums of those who do not file claims help pay for those who do. Insurance is also built around probability, not certainty. Policies are priced based on how likely a specific type of loss is to occur across a group, not whether a specific individual will need help. This means insurance decisions are statistical by nature, even though the outcomes feel very personal. Understanding insurance as a risk-sharing system, rather than a personal safety net, helps explain why coverage has limits, exclusions, and conditions. These features are not mistakes. They are structural elements that keep the system functioning. Insurance is not a savings account. One of the most common misunderstandings about insurance is the belief that premiums work like deposits. People often assume that if they pay into insurance for years without filing a claim, they should be owed something in return. In reality, insurance does not accumulate value the way a savings account does. The money paid in premiums is used continuously to support the pool of policyholders as a whole. Once a premium is paid, it is no longer tied to the individual who paid it. Consider a homeowner who pays insurance premiums for 20 years without ever filing a claim. From their perspective, it may feel like wasted money. But during those 20 years, their premiums helped cover losses for other homeowners who experienced fires, storms, or theft. A common misconception is that filing a claim is simply getting your money back. This framing causes frustration when claims are denied or partially paid because the expectation was never aligned with how insurance actually works. Insurance is better understood as paying for access to protection, not for a future refund. Each premium payment maintains membership in a system designed to respond when specific, covered events occur. This distinction matters because it shapes expectations. When insurance is treated like a savings vehicle, disappointment is almost inevitable. When it is understood as a shared risk arrangement, its behavior becomes easier to predict. Insurance does not eliminate loss. Another widespread belief is that insurance exists to eliminate financial pain entirely. Many people assume that if something bad happens, insurance will restore everything to the way it was before. In practice, insurance is designed to reduce financial impact, not erase it. Most policies include deductibles, limits, exclusions, and conditions that define how much assistance is provided and under what circumstances. For example, a business owner may suffer property damage that disrupts operations. Insurance may help cover certain repair costs or lost income, but it may not address every consequence of the disruption. Stress, inconvenience, and indirect losses are typically outside the scope of coverage. A common misconception is that uncovered losses indicate a failure of insurance. In reality, insurance is designed with boundaries because covering every possible outcome would make premiums unaffordable for most people. Insurance functions as a stabilizer, not a shield. It absorbs part of the financial shock so a loss does not become financially devastating. Expecting insurance to remove all hardship often leads to misunderstanding and frustration. Understanding this limitation allows people to think more clearly about what insurance can reasonably provide and where personal planning or risk tolerance fills the gaps. Insurance is built around probability, not fairness. Insurance systems are designed using large-scale data, not individual fairness. This can feel uncomfortable because insurance outcomes often affect people during emotionally charged moments. Premiums are calculated based on how often certain events occur across large groups. Claims are paid based on whether specific conditions are met, not on how deserving or unlucky someone feels. For instance, two people may experience similar losses, but receive different claim outcomes due to differences in policy language, coverage limits, or exclusions. This can feel arbitrary, even though it is consistent with how insurance contracts function. A common misconception is that insurance decisions are moral judgments. In reality, they are contractual determinations. Policies outline what is covered and what is not, and claims are evaluated against those definitions. Understanding insurance as a probability-based system helps explain why outcomes can feel impersonal. The system is designed to remain financially viable over time, not to adjust dynamically to individual circumstances. This does not mean insurance lacks compassion, but it does mean that consistency and predictability take precedence over subjective fairness. Insurance exists because some risks are too large to handle alone. Many everyday expenses can be handled individually. A broken appliance, a minor repair, or a routine medical visit may be inconvenient but manageable. Insurance exists primarily for risks that are financially disproportionate to most individuals' resources. Events like severe accidents, major property damage, or extended illness can exceed what many people could reasonably pay out of pocket. A realistic scenario might involve a homeowner facing extensive damage after a natural disaster. Without insurance, the cost could exceed years of savings. Insurance does not remove the disruption, but it can prevent financial collapse. A common misconception is that insurance should be used for every loss, large or small. In reality, insurance is most effective when reserved for significant events that would otherwise be difficult to absorb. This is why many policies include deductibles, to discourage use for minor costs and preserve the system for larger losses. Insurance is not designed to replace everyday budgeting or emergency savings. Insurance is a contract, not a promise. Insurance policies are contracts with defined terms. While marketing language may emphasize peace of mind, the actual function of insurance depends on written agreements. These agreements specify what events are covered, under what conditions, and to what extent. Anything outside those terms falls outside the scope of coverage. For example, a renter may assume all personal property is protected, only to discover certain categories have limits or exclusions. This is not a hidden trick, but a contractual boundary. A common misconception is that intent matters more than wording. In insurance, wording is the foundation. Policies are enforced based on definitions, not assumptions. Understanding insurance as a contract encourages a more practical approach. Rather than relying on general impressions, clarity comes from understanding the structure and language used to define coverage. Insurance confusion is structural, not personal. Many people blame themselves for not understanding insurance. In reality, insurance is inherently complex because it must address many scenarios while remaining financially sustainable. Policies are written to be precise, not intuitive. This precision helps prevent ambiguity but can make policies difficult to read. A realistic scenario might involve a policyholder who assumes coverage based on a general description, only to encounter specific limitations later. This experience is common and does not indicate carelessness. A common misconception is that everyone else understands insurance better. In truth, confusion is widespread, even among experienced policyholders. Recognizing that confusion is built into the system helps reduce frustration and encourages more thoughtful engagement with insurance decisions. Strategic takeaways. Several patterns emerge when insurance is viewed plainly. First, insurance is about risk sharing, not personal reimbursement. Premiums maintain access to a system, not an individual balance. Second, insurance reduces financial impact, but does not eliminate loss. Deductibles, limits, and exclusions are structural necessities, not defects. Third, insurance operates on probability in contracts, not fairness or intent. Outcomes are shaped by definitions and data rather than individual circumstances. Fourth, insurance exists to address large, infrequent risks, not routine expenses. Using it for the right types of losses helps maintain its effectiveness. Finally, confusion around insurance is common because the system prioritizes precision and sustainability over simplicity. This does not make insurance unmanageable, but it does require realistic expectations. Understanding these patterns allows insurance to be evaluated more calmly and used more effectively over time. What this means going forward. Seeing insurance clearly changes how it fits into everyday life. Instead of viewing it as a promise or a guarantee, it becomes a tool with a specific role. This perspective encourages better questions. What risks would be difficult to handle alone? What trade-offs exist between cost and protection? Where does insurance end and personal planning begin? Insurance works best when expectations are aligned with its purpose. When it is treated as a shared safety mechanism for major risks, its structure and limitations make more sense. This understanding does not require memorizing policy language or mastering technical terms. It requires recognizing what insurance is designed to do and what it is not designed to do. With this foundation, future discussions about deductibles, coverage types, exclusions, and claims become clearer and less frustrating. This has been for educational purposes only and is not legal, financial, or insurance advice. Insurance policies vary by provider, state, and individual circumstances. Coverage terms, conditions, and exclusions differ widely. Readers should review their own policy documents and consult appropriate professionals for guidance specific to their situation. InsureNook here wants to thank you for viewing and listening to these videos of educational purposes. If you do want to help the channel here for this education, you can give a like or subscribe for more videos related to this subject, and we'd be glad to help you along in understanding. Thank you.